Uncertainty regarding a financial outcome or loss. That's risk. It used to be that risk, until ISO 37000, which is the ISO for risk managers, it wasn't until then that we looked at risk as a positive thing. For many years, risk was a negative thing. We dealt with risk. It was uncertainty. It wasn't until this consortium got together, this ISO consortium, and started talking about it and said, wait a minute, when managed properly, risk is an opportunity, a great opportunity. For those who know that remember car racing back in the day, Mario Andretti and those guys, right? Grand Prix. You get one of these fast cars and he's going to take a turn and he takes the cut and he gets in front of the other car and you see him pass the other guy. You're like, wow, he took a risk, he took a gamble and it paid off. Sometimes gambles paid off, right? All of you here are hoping that the gamble that you call your entrepreneurial spirit, what the company that it is that you want to build for yourself, you're taking that gamble right now. You want to see it pay off. So there is a certain amount of risk involved with the endeavor that you've chosen to take. The outcome might be a loss, but like you guys are here educating yourselves, gathering data as much as you can, filling up your head with it so you mitigate the amount of uncertainty by learning. Before you put money into it, or some of y'all have already put lots of money into it, right? But at least now you're looking at risk. Insurance is basically just a social device to deal with this risk. A policy itself is a contract between an insurance carrier which promises to provide a certain level of protection in the event of a covered loss. Notice there's a lot of little legalese in here. Promises, covered loss, and protection. They're not promising that they're going to cover everything, only the covered losses. And that's where people make a lot of mistakes because they buy a very cheap or inexpensive policy that might not cover any of the things that they need covered. So when they do have that accident, when they do have a lawsuit, when they do have an injury in the workplace, if they didn't have the proper protections covered under policy, there's no protection given for them. So coverage and different types of risks. In insurance, there's only one type of risk that we can cover, okay? And you have to understand this. Pure risk is insurable. Speculative risk, we can't insure, okay? So an accident, an unintentional, it has to be accidental, unintentional, always results in a loss, and it can be personal property or liability risk. Those are pure risks. If we look at speculative risk, loss or gain is possible. That's like me going to the bet at the horse races, right? That's a speculative risk. It's like me in the stock market. I'm speculating. I can't insure against my losses at the horse park. I can't insure my losses. I can hedge my bets. That's different than insurance, okay? So here what it's trying to say is making sure that you understand that there's some things that you're going to get into that is purely speculative that there is no insurance out there for. You're just going to have to manage it, how to hedge it. You might have to have enough money in the bank to offset this risk. But then on the pure risk, things that are accidental, unintentional, acts of God, things like that, yeah, we have some sort of coverage for that. Individuals, an individual is the insured. That's the person that we're insuring. That would be you guys. Yes, sir?
Can you define the application?
Hedging. Hedging would be, let's say that you're taking a gamble on the upside, that things are going to go up. But you also buy another bet, betting that things are going to go down to offset the loss, right? Exactly. You cover your upside and your downside. When you do that, your upside is never as good as it would have been because you had to put money towards your downside, right? And in stock market, people hedge all the time. Hedge funds, that's all they do, okay? So those are the type of things. Individuals, that's you guys. You're the people that are the insured. The insured's responsibility is to retain risk. They can't do anything about it if an airplane falls on the house, right? Something happens like that, that's what homeowners insurance is for. You don't have homeowners insurance and a plane falls on the house, what do you think your next level of recourse is going to be? You're going to call a lawyer, which then they're going to take on contingency and hope to win, and then the airplanes, let's say the airline, they're going to be the ones that pay through their insurance that claim. Or you could choose to ignore risk. A lot of people do this. They don't buy flood insurance, but they live in a flood zone because they're like, gosh, it's a $200 Melania storm, and we had one last year in Houston. So I'm not gonna buy a flood. But then we have a flood again this year. You know, it's that kind of stuff. Avoid risk. So you can avoid risk by completely not buying like don't buy in an earthquake area. Move away from flood zones. Maybe if you're concerned about travel, you know, you don't travel on an in an airline because you're afraid, you know, that you might not be covered in the case of a loss to yourself. Or you just drive slower. There's things that you can do to reduce risk. And then transfer risk. Finally, when you decide to transfer risk, it's basically you bought a policy to offset the risk. So you can choose to take it, just accept it, avoid it, reduce it, or transfer the risk. Those are your options when it comes to risk management and understanding insurance. So when I'm talking to people, one of the first things that we try to do together when I'm having a consultation with the business is ask them, tell me about the nature of your business. What's the worst thing that can happen? Dream it up, because I don't know your business like you know it. But if you tell me what the worst thing that can happen is, I can tell you, should we avoid it? Do we retain it? Do we find a way to reduce our exposure to that risk? Or do we just buy insurance and just pray for the best and understand that that's just a cost our business is going to have to bear to move forward? So insurance companies, now that we've talked about what we do as individuals, as an insurance company, they spread the risk and they reduce the risk. Why? By spreading the risk, that means that not one catastrophe can shut them down. There is one catastrophe that almost, well, two in our lifetime so far, that have almost shut down the insurance markets for good. I mean, not for good, but like killed it. Okay? One was the economic bubble collapse in 2007, 2008. Insurance markets were highly leveraged during that. I implore you to watch any one of the dozen movies that are out there that make fun of the insurance market and show what a catastrophe that would have been had AIG gone down, right? Which is an insurance company. So they also spread the risk. But if you think back further, let's think back to the early 90s, late 80s, where you had hurricane after hurricane pounding Florida, and then one day State Farm says, we can't pay. Sorry, sucks that you lost your house, but we can't pay. So that's why they spread the risk now. Not one company, not one major carrier is entrenched in one geography anymore. They try to spread it around. They also try to spread it around to different countries if they can. So if the United States or America's having a bad time, hey, China's having a good time, they're going to offset. They're hedging. Okay? Financial, they create premiums in different dollar ranges. They also, on the financial, check credit, right? I don't know why, but apparently they've decided in their models that credit will decide the propensity for loss. So if they think you have a low credit score, even though it has nothing to do with the fact of your insurance, they will see it as an actuarial table that tells them, at a 580 credit score, he's 3 times more likely to get into a car accident.
So I know it's a big deal with P&C risk, but is that also the same big deal with business liability?
Yes, yes. And when it comes to directors and officers insurance and E&O claims. Because a director and officer that's seen, let's say, at a 500 score might be quick to commit some sort of fraud against the company, take out cash or anything. So they do look at that. On risk reduction, underwriting guidelines, they can make it tough for you to get insurance. They can say, oh no, your retention needs to be much higher, or you're gonna have to pay higher deductibles for that kind of insurance. So they might have very specific guidelines. I don't think a day goes by where I'm not arguing with an underwriter about their guidelines and trying to sneak in or get in or push in one of my clients to get some sort of coverage that an underwriter saying, we don't want to cover that, or we're afraid of that, or we don't understand it, or they try to tell me the business and then I come back to you and you have your motorized, fix-it service, and I try to tell them, like, look, don't you understand, they don't drive and fix it. They pull over, they meet them somewhere, because the underwriters, they live in this world of not understanding anybody's business. So they will automatically assume, you're a chef, you poison people. So we have to assume that he's going to poison 12 people this year. That's how they think. So we have to tell a better story than the contrived story that they have in their mind. Which is why it's super important that you guys have a tight connection with your broker, and your broker needs to tell that story for you. If your broker's not telling that story, you're not being served well, okay? That's really important to remember. And then there's safety, well, discounts, you know, for, of course, alarms, non-smokers, defensive driving, safety programs. This is something that's becoming more and more used. I came from the safety side, jumped into the insurance side, and went back into risk management to bring it all together. So on the safety side, we do massive reductions in premiums by having safety programs installed. By going back to an underwriter and saying, look, those shock losses that we took the last 2 years from a guy losing his arm, or the guy that fell and knocked his head and he's dead now, that's not gonna happen anymore because look at our programs that we have. We have these OSHA-approved programs, we're having OSHA-approved training, we have guys coming out, we're aspiring to be VPP, which is Voluntary Protection Plan for OSHA. We say all these things, we tell the right story, and the underwriters will work with you, okay? Catastrophic claims aren't as bad as you think. It's when you have a high frequency that they start getting worried about you. So when I'm making a decision based on risk, I always say low frequency, high severity, low severity. Which one is it? Okay? So Pedro can't swim, so I'm going scuba diving. High severity, high frequency, right? So low frequency means that I'm only going to do it once, probably, right? So there's not a lot of frequency in there. But the severity of me doing it is probably going to be death, right? So let's put in something that's a little bit more tangible that you guys would understand. So if I'm buying life insurance, I'm just going to give you a real example for one of my clients, okay? So one of my clients, every day they climb smokestacks at power companies and factories and stuff like that. And usually they're elevated higher than 800 feet. Every day. So is there a lot of frequency? Yes, it's every day. Their biggest fear, their biggest catastrophe would be if one of these guys fell. Okay, so what is the severity? Death. It doesn't get any higher. So high frequency, high severity. As an underwriter, they're going to look at that and say, rates are going to go up. Or underwriting standards are going to be blown through the roof, or we're not even going to look at this policy. We can't write it. That happens to this company a lot. Happens so much to this company that they couldn't find any insurance, even on the global market, and they had to do, which we'll learn, a self-insured retention of $5 million. Basically, that's me telling you, if you came to buy insurance from me, like auto insurance, and I'm like, hey, that's great, that's a fancy car, yeah, we can get you insurance. However, you have to pay the first $5 million of damage. And then you lock it in, all right? What's the likelihood you're gonna blow through $5 million in a year? Well, this company, their lawsuit claims against them and death settlements and stuff, they were going through $8 to $9 million a year, every year, averaging 2 deaths a year, okay? For the last 17 years. So it's not like I could show an underwriter a happy story there. Hey, it is what it is, dude. They're gonna die. So let's price it. So all right, we're gonna price it, and we can't insure anything up to $5 million. After $5 million, we'll kick in for the next $25 million. Okay. Do you know how many times we have actually stepped into that $5 million category in the last 4 years that I've had them as a client? So now is the time, maybe last year was the time, and I told them about that. We need to start talking about reducing that self-insured retention. We don't need to hold on to $5 million of loss if we're not even close to $5 million. Let's start getting back into the world of real insurance again, since we've curtailed the losses that we've been having. But you need to start in your head thinking about risk in this category. Anything that you're going to do in your business as you launch it and start it up, and think about it. Even in the inception stage, it's risk, severity, low severity, or frequency. Think in those terms when you're making your decisions. And in the chef, okay? Let's say in the restaurant. Some of the things that I see, high frequency, low severity, there's lots of just trips and sprains and wet floors and burns. Not a high severity, but there is a high frequency, right? Low severity would probably be, or excuse me, low frequency, high severity would be somebody getting burned really bad. You know, that happens once in a blue moon, okay? Some more definitions we need to know. We need to understand a peril, because you're going to see that in your property language or your coverage language. It'll say, this peril is covered. If that peril is not covered, if it's not stated, it doesn't exist in their mind. So a great example of a peril that snuck under us on this one here in San Antonio with an agency I was with here was a peril for airborne hazards. Inhalants was not covered. Dust particles. Okay, you would think that's not a big deal. Well, this concrete company, it mattered to them because what is concrete? Pretty much dust until you mix it with water. These people were inhaling it, 2 people got sick. It was not a covered peril. They needed specific cause of loss. That didn't cover it, so there was no payment for that. Now we found payment through another remedy, but you gotta be careful with the peril. Then you have named perils and all risk. All risk policies, if you're used to listening, like when you're looking at car insurance, it was comprehensive, right? Comprehensive coverage, I need comprehensive. That was like my parents used to tell me. When you get it, make sure you get comprehensive with a low deductible, right? No, you don't necessarily need that. And there's no such thing as comprehensive anymore. When you call your insurance agent and you say, I need a comprehensive policy, if they're good, if they know what they're doing, they should say, tell me what you want, because there is no such thing as a comprehensive policy. Comprehensive to you might be different than comprehensive to you. I know it's different to me, because my car's paid off. So at this point, my car's paid off, it still drives well, I have money in the bank. Okay, I don't need comprehensive, I just need liability. If I hurt somebody else, if I try to get sued, like the guy I ran over here, 2 years ago I ran over a cyclist. It was his fault, I didn't get in trouble, right? And my insurance company stepped up. But they were like, yes, cyclist is a named peril, you don't have to worry about it. He was like stuck under my car. He wasn't looking, and I was going, it was a turn only lane and he went straight. So just so y'all don't think I'm a bad driver. All risk. If you get an all risk policy, it's gonna be more expensive, right? But there's less thinking with it because everything is covered except what's excluded. Everything is covered except what's excluded. What does that mean in your mind? That means it has to be on paper. Everything's covered except what's excluded. And they will make it very tricky, usually on the back pages of your policy, they put all the exclusions. Because they know, and I know, nobody takes home those documents and reads them all. At the beginning it says, look at your coverage. The first 5 pages just talks about this great coverage you just bought, right? And then you get to page 47, 48, you're falling asleep on the toilet reading it, and there it is. This excludes chefs from getting any sort of payment. I'm not kidding. They'll put stuff like that in there. And if you don't read through it, or if you don't have your broker walk you through it, you gotta be careful. And I'll even tell you an even worse example than that here as we go forward. Proximate cause, direct physical loss, and indirect consequential loss. The proximate cause is the covered peril, okay? So a covered peril is a proximate cause. For example, I'm walking through the forest and I'm smoking and I throw my cigarette butt. What was the proximate cause of the forest fire? Me throwing the cigarette butt, right? That's important that you use proximate cause to think about what caused whatever it is that you have in your policy language that's causing it to kick in. Direct physical loss would be like a lightning striking a building, or a fire, or a torrential windstorm. Those are direct physical losses because they take it out, they just wipe it out. Indirect consequential losses is loss of use. There's lots of lawsuits, not because of damages that you did physically to somebody else or to their property, but I work in the refinery side in Galveston and Houston area. We had a guy in a pickup truck with a weed whacker. That's their business. All they do is they basically weed whack the insides of refineries because no grass or trees or anything is allowed to grow inside the fenced areas. As he was backing up his truck, boom, he hit a condenser tower, knocking a little hole into it, just about, $17 million worth of damage. Loss of use. Not only did they sue Allstate, which was his carrier, not only did they sue for the damage to the big condenser tower, they sued all the oil that they would have produced in the next 3 months while it's out of production. Indirect consequential loss, loss of use. I-10, this was a really fun one. I-10 about 2 years ago had a pipeline blow out just past Sealy, and the fire was shooting across I-10. And they shut it down for a whole day. How many trucking companies do you think sued that pipeline company for loss of use? Couldn't use the damn highway to get my goods and services to over there, so Piggly Wiggly didn't get their steaks from Pasadena which means that they all rotted, which means you're gonna pay for that, but also, you're gonna pay what they would have paid me for that. So think, it goes deeper than just the initial loss. And whenever something like stops something, or somebody plays a trick or a prank which causes a disruption, or think about the Boston bombing. Okay? During the Boston bombing, they shut down Boston. There was no work being done. All those businesses in the downtown district that depended on people coming in and out, there was a loss of use there. So if they didn't have the proper insurance, and most of them did, they called their agents and said, I just lost $30,000 this week because we were shut down because we were looking for some crazy guy that's a terrorist. Y'all gonna kick it in? Y'all gonna pay? Depending if it was, whatever the proximate cause was written in the language, depending on what the peril was, if it was properly policy, then it would pay, all right? Which is why, interestingly enough, you saw the president get on and say, it's an act of war. No, it's an act of terrorism, real quick, because active wars are not covered under any insurance policy, right? So it's all strong language because the insurance company's like, yes, he said act of war. You're really paying nothing. And then he came back, I meant, not an act of war, it's a terrorist. Gotcha. All State Farm, you're good. You gotta pay. So you gotta worry about things like that too. Hazards, some different hazards. Remember we talked about risk and we talked about hazards. Hazard is the situation that introduces or increases the chance of loss or peril. So there's physical hazards and moral hazards and then morale hazards, right? Physical hazards, storing fireworks in the garage like I did. Yeah, that's a physical hazard. Having a child care in the home, an unfenced pool, those are all physical hazards. Moral hazards are dishonest acts of an insured which increases the chance of loss. Character, living habits, financial responsibility, fake claims to get money when out of a job, all of those are moral hazards. And then morale hazards are the attitudes of the insured that increase the possibility of a loss, right? So sometimes you have dishonest acts will hurt a company. If you're starting your own company, you might have, and trust me, but you'll probably hear the story around these places. Sometimes partnerships go bad. Sometimes partners will rob you blind. Sometimes all those type of things go bad. And those are moral hazards, dishonest acts from one party to another, which is important that you look at how you structure your company entity and how you get insurance to protect yourself, because although I love my brother, going into business with him, I don't love my brother that much. Like, he would take my bank account if he could. So, no, you gotta put some insurance in place to protect yourself from dishonest acts.
What is that insurance called? Like partnership insurance?
It's like a directors and officers, D&O, and you can also cover it under the GL policy in different types of ways, depending on how you structure it. What's that? Mm-hmm.
Yeah, like the partnership and stuff.
So you can do a buy-sell agreement also, that's a different type of insurance we'll get into a little bit later, but also there's also, we'll get into this, there's gonna be another type of policy that I want you to strongly think about, especially as your business starts to make money and you can't afford to lose it. If you're the one thing that's driving your business, you have to insure yourself, or if there's a guy, like I had a sales guy for a long time, that would make cold calls all the time, he was very valuable to me, so I put insurance on him in case that he up and died, it would shut down my business, because he's the one that was generating all of our leads, all our calls, right? If you have a master technician, an ASC certified guy, that you can't afford to lose, you might have to take insurance on him. My company has taken insurance on me, because there's nobody else in my company that can do what I do. And I drive a lot of revenue back to the company. So they've taken out insurance to protect themselves in the event that I'm like, I'm out. I'm not taking half, whatever. All right? So they gotta have that. Indemnity. When you indemnify, property insurance is a contract of indemnity. It returns the insured to a financial position prior to loss. This is where people screw up insurance all the time. They think insurance, I'm getting a new car. No, you're not. You didn't have a new car when it wrecked. You get indemnified. You get made whole. Made whole means I'm going to take you to the point where you were at the time of loss, right? So if your car, when it came off the lot, was $44,000, and it's 2 years in now, and that's now worth $24,000, and you wreck it, and it's totaled, you're going to be lucky to get $22,000 out of it of that insurance, unless you argue very hard, and then you get to 24, let's say, because they're going to say, I'm just making you whole. You should have taken gap coverage, right? They'd come up with another type of coverage to get you that gap, but then you're paying more, right? You gotta pay for what it is that you want to protect. Liability. Liability is the legal responsibility for a loss to someone else. Either bodily injury or property damage. Casualty insurance provides this type of coverage. So, casualty coverage provides liability. Liability is third-party coverage. Liability, nothing for you. You're not gonna get anything out of it except get him off your back or get them off your back. So remember that. When you're looking at liability coverage has to do with protecting, giving something back to somebody else that is holding something against you.
So when you, for a business, what type of, like, what liability do you guys give instead of like?
Whenever you're working with customers in a way that might hurt them or harm them, or if you can imagine that there might be a lawsuit against you. For example, let's say you burn somebody's hair and it's Beyonce and she's pissed off at you now, right? She's probably gonna sue you, so there's a liability coverage that would be able to pay off her lawyers and pay her off for basically being, you damaged her. You damaged something of her, you harmed her.
You can't go get a spear, that's what you're trying to do. So you say it comes from hair.
And flicker died.
So something that will happen in effect of what you said, or something that could happen.
Probably better just die. Okay. Before you can buy any sort of insurance, first off, you have to have an insurable interest on the party itself. So, insurable interest must exist in order for an insurance contract to be legally enforceable, whether it's life insurance or property casualty insurance. If it's life insurance, it's not required because I can take out insurance on my mom and dad. The interest to me is that if they're gone, there needs to be something to take care of the household, to pay off their bills that I'm going to inherit. Property and casualty, all parties named must have an insurable interest. So when it comes to property or casualty insurance, business insurance, everybody that's named in the policy has to have an insurable interest in the company. I'm doing this one. Here's a more advanced term, is co-insurance, okay? Co-insurance requires that a property be insured to at least 80% of replacement cost. You will find out as you get into properties and buying properties and insuring properties that if you don't meet the co-insurance requirement of at least 80% in the state of Texas, you're gonna have a very bad day when you go to cash out if there's damage to the property or the property's at a loss completely. They're not gonna pay out the full amount because they're saying that you didn't put your stake of the co-insurance, you didn't insure it enough to cover the property adequately. So they will tell you, they'll make sure. And where people get in trouble and they get stung is, especially on homeowners, and we're not talking about the personal side, but I'll bring up homes real quick. On homeowners, property values go up, right? But when you bought the house, it was only $100,000. And so you were insuring it at 80% level. So you were only paying like if it was an $80,000 house. Now the house is worth $200,000. So you're really in the hole when it comes to insurance. Insurance is only going to give you that 80%. So they're only going to treat that house like if it was an $80,000 house, not a $200,000.
And that's how you get cheap homeowners, because they don't care. All they want to do is sell the policy. They're not looking at your numbers.
It's important that you look at the numbers. Otherwise, you're buying paper that's not protecting you. If there's anything you get out of this class today, is that there's lots of paper out there that won't protect you, and if you don't know what you're shopping for, somebody can give you a policy, and if they don't know what you're wanting out of it, I'm not trying to say that they're nefarious or trying to hurt you, but if you don't explain what your goals are to them, they're left on a limb like, okay, they really just wanted $80,000. They don't want more.
What about owning a home business?
Same thing, owning a home business. All insurance needs to have you have to have stake in the game with the policy. Okay? So it'll be very clear in the policy papers telling you about what that co-insurance might need to look like. If it's not in any of the policy papers, make sure you ask your broker, is there a co-insurance clause here? Don't be afraid to ask that question, because they'll tell you. And a value policy in the state of Texas, a full policy amount is paid in the event of a total loss. Not in other states. In other states, your policy might be a $200,000 policy, but the state laws say that they don't have to pay out at 100%, depending on how old the house was, or other multitude of other reasons. So at least here in the state of Texas, we have a value policy. It's just not good. It's fine. I can just keep clicking on this. That's fine. So the basis of coinsurance, they're going to look at actual cash value versus replacement cost. That's something that's going to come up both on auto, property, tools, whatever. They're going to ask you, especially when business auto, right? When you have a vehicle going around, they're going to ask, do you want replacement cost or actual cash value? If it's new, I like actual cash value, that's just me. Pay me what it's worth me. Replacement cost, if I have an old beater and it's only worth $2,000, I'm not gonna pay more for actual cash value, I'm gonna just pay for replacement costs. It's gonna be a cheaper policy, and I just wanna replace what that was, let's just replace it. Give me something similar. That's all I care about. I just need something that runs. So what it would cost to replace the item at today's prices versus what the items are worth at the time of the loss, used goods. It's important that you understand those terms. So insurance principles continued. There's ambiguity in all policy language, which is what I was telling you. When you get to page 47 and you're still reading it, so ambiguity is interpreted, fortunately, in the insurer's favor. So if the carrier, if the policy owner, if the broker, the policy giver that gave you the policy, if the policy wasn't written well and it was ambiguous, they're going to side with you. Okay?
If I'm not mistaken, that's a new rule.
It is. It is a new rule.
So if you have an old policy, you need to update it.
Yeah, absolutely. And your broker won't tell you that. So you need to know that your policy is greater than 3 years old when this new rule came into effect, and possibly have new wording. Most of the time, big companies, they already use ISO standard language, okay? And TDI has created the format, so this is already taken care of. The importance of courts in insurance decision is new language and provisions are tested through the court system. So when you want to fight for your rights, you actually have to fight through the court system in order to have somebody step in and say, halt, by the way, they're infringing on your rights, that policy should have covered it. Or no, that policy doesn't cover it. You're going to see some case law here as we start getting into it. Oh, that was my risk mitigation, so we're in part 2 now, which puts me on time. Yes, sir.
But how's it taking play, mitigation, I'm sorry, oh my gosh, I just lost it. Yeah, the thing you're going to, other than going to court nowadays.
Arbitration. So, under arbitration, some of the policy language says that you are subject to arbitration, and that's how that's basically what you're gonna end up doing, okay? So through arbitration, you're gonna sit across from them, and you're basically gonna come to an agreement on what the settlement is gonna be. You can't sue for unspecified damages. You can't go above and beyond. Now, the new language doesn't change anything about your ability to have mediation or arbitration. TDI still lets you mediate and arbitrate. In many cases, mediation and arbitration sides with who? Who do you think? The insurer. Okay? They're going to make a more elegant case than you, because in many cases, you're fighting the insurance company that has the resources. You don't have enough resources to lawyer up, and your policy doesn't cover you suing the insurance company for damages. However, as I get to the end, you're going to see one of the things that I highlight in bold, you need to fight for your claim. If you don't, nobody runs for you. There's very few agencies out there, I've known 2, that have internal claims adjustment people on our side, meaning our side. Because most of the time what you have is the claims adjusters are working for who? The carriers, right? So they're trying to minimize how much they're going to pay you. If you have an internal claims adjuster that knows how to speak the language, working at that agency, they're butting heads with that person saying, nah, I call BS. Read line 4 where it says, I construe this to mean this, so that way that they're fighting on your behalf. That's really important. So before we get into all the damages and stuff like that that can happen, how do we risk mitigate? How do we keep it from happening? Okay, first, risk, what is it? Risk is the possibility of loss. Whoops, sorry. Risk is what makes you decide whether you need insurance or not. Risk is also what insurance company use to measure how much they're going to charge you, right? The riskier it is, the more you're going to have to pay for it. So here's some ways that you can handle risk. And we talked about it. We talked about avoiding. You can avoid it completely. You can try to retain it. I have money in the bank. If that ever happens, I'll pay it outright. This is not a big loss. I can transfer the risk by passing it to an insurance company, making them hold on to that burden, or I can have loss control measures in place that will minimize the chance of that happening to me, okay? So this loss control measure, this is something that's really just become avant-garde in the last 10 years, where people are starting to look at things like Six Sigma and lean analysis and different types of models on behavior models or behavior-based safety programs that will minimize the chance or the likelihood that their employees will create a loss to the company, okay? Through loss control measures. Yes?
How do you, as far as the safety program goes, for someone like us, like small business, you have to have like systems in place? Is there specific like resources where you can go and get?
The best resource
Safety programs for that?
I'll tell you, the best resource for a 1 to 10 size company, 1 employee to 10 employees, is gonna be OSHA Online, okay? They have a whole resource package already pre-built for you to go in there and create your safety program for your business. It's already on there. It's built for you. Also, it'll tell you what is it that you have to do to be in compliance. Because even at 2 employees, you're OSHA compliant. As long as you're not a sole proprietor for yourself and you're in your own business for you, you have to be OSHA compliant in the way that you do things. Unless you're a farm worker or a sole business owner, sole proprietor, then you don't fall under it. But once you have 2 employees or greater, once you get to 10, you have to start reporting. Okay? So you have to know that kind of stuff. That's really, really important. But those all fall under loss control measures. But imagine if I was gonna be your carrier for your restaurant that you're gonna open up. And that's a question that you asked. I would immediately be, oh, this guy doesn't know. I think his rates just went up about 50% because obviously you don't know what control measures. So those are the type of things that you need to find out ahead of time, right? And so you sound smart with your broker, so you sound, oh, you know what? Since you're not talking to the carrier anyway, you're talking to your broker's really the one that has to have your back. And be like, he's been in the restaurant business for 27 years, he's done Outback, he's done Papados, he's done this. He not only managed, he ran office, he also was part of the insurance buying. All that kind of stuff sounds really good to an underwriter. Because then they're like, he has his head on right, he's gonna understand that he needs to have loss control measures in place. Okay? When they rate you, they're already assuming that you're doing something to keep yourself safe. Remember? Because in order for it to be insurable, you can't be out to burn your own building down. Okay? So they already under the assumption that you've done something. I've had companies ask me, Pedro, can you come out and do an OSHA 30-hour class for all my 70 employees? And I'm like, why? All right, so my insurance will go down. They're already assuming that you guys have that level of knowledge, so if I come out and I do it, and then I tell them, they're gonna say, hey, I thought they had this all along. Great, what else don't they have? So when I told her that, she was like, oh, I thought it would reduce our rates. I was like, no, not directly. Having a loss control measure program doesn't directly affect your rates. It creates an environment where people aren't getting hurt all the time, or you're not doing sloppy work, okay? The red Corvette theory, that's right. Remember, insurance is a legal contract, talk to a lawyer, it is legal, right? How insurance works, you pay premiums, the insurance company sucks up the premiums, they enjoy it, they pay people like me, and then it goes out and pays for claims as well, okay? So what type of risk does insurance cover? Here's some examples that I threw together, right? You lose your job, there's mortgage and credit insurance risk. It'll cover your debts for a fixed period of time. Your stocks lose value, there's no insurance in place there, there's no coverage. You have a car crash, you have auto coverage, you pay for damage to your car or other people's cars. So the types of insurance, understanding the products available to business owners. Now we get into the meat of it. These are the products that are out there that are available. This is not all encompassing, because I only had 2 out. Right. Is there insurance for everything? Virtually everything can be conducted, virtual conduct can be covered, but there are some gaps. Sometimes you might have heard of something called Lloyd's of London, or General Lloyd's, or things like that. That's like an insurance clearinghouse for things that you just can't find good policies for, or you don't have a lot of people covering that. The whole Lloyd's thing, in the history, I should have put it up there, but essentially it was this tavern in England where people that were doing shipping would post and post-it notes up there. Hey, I'm going to the West Indies, have 80 tons of sugar, have some space, who wants to send it? And then other people would put, I want to go on there, but then other people would say, if you're shipping something, if you pay me 2,500 pounds, I'll insure it against loss. If it gets lost, I pay for the full cost that I bear the price on of the loss. But if it makes it, I keep all the premiums, right? That's how it works. So these people that were putting their money out there, insuring these vessels coming across, they had actuarial tables, they ran the numbers, They were like mathematicians, right? They figured it out. They knew how to play the game. Did they get burned sometimes? Oh yeah, they got burned. But they had enough in the bank to cover a couple burns, right? So anything, even J-Lo's butt is on there for insurance, right? We all heard that, and that's true. She does have insurance. Some examples. Co-employees. Standard insurance forms generally includes employees while operating within the course and scope of their employment, unless the injured individual is also an employee injured during the course and scope of employment, right? You're gonna read stuff like that on policies left and right, okay? Here's a simple exclusion that a lot of people don't know about, right? So the GL policy, which is a liability, third-party claim, that means I went to Margot's place because we were doing Habitat for Humanity, right? And so my company, Maxim Group, sends all of you guys, Habitat for Humanity this weekend. You're on the job, volunteering, and the hammer falls, and it hits you, who's the recipient of the house, in the head, killing you. So then you sue Maxim Group. Maxim Group says, I'm covered, I got general liability insurance. Sucks that the hammer hit you and killed your girl, but we're covered. Policy then comes back and says, wait a minute, was that your employee volunteering to do something? Well, yes, it was. I'm sorry, that's excluded. So you gotta be careful with some of the language on some of these ISO policies where they exclude things. And that is a well-known exclusion. Because why? They don't want to take on the liability burdens or risk when it's supposed to protect you during the course of work, not during the course and scope of volunteering. And you do damage and hurt somebody else, they would hope that you're carrying your own homeowners or renters insurance that has a liability clause in there that will pay that kind of damage. You'd be surprised what kind of coverage you guys have that you don't even know you have. I could go to your house right now, drop my laptop and break it, and file a claim against you. I'm like, man, your house is scary and you made me drop my laptop. And you're like, well, Pedro, I'd be happy to pay for it. I'm like, no, that's okay. You have homeowners? Yes, I do. That's okay. Hey, Allstate, I dropped my laptop at my friend's house and it broke and shattered. File the claim. They'll pay for my laptop. Right? Little things like that. But here's some other stuff that it won't cover. You have a friend come over and their kids are playing in your backyard. No, let's make it even worse. Your next door neighbor has some rugrat kids that are crazy and they jump your fence all the time and you have a pool. You have a fence that's 8 feet tall. You have cameras and lights that turn on when anybody that should be in the backyard is back there. The kid jumps over the fence, gets in your pool and drowns. You're not covered for that. You want to be covered for that, but you better check your policy statement because the last 14 that I've read in the state of Texas with old ISO language, like you said, if you gotta have an update of your policies, there's exclusions on there that exist from back in the day that you're probably still living with. You would think that would be covered. It's an injury to somebody else on your property. They're not gonna cover it because they said you did not do enough to keep it from happening. Well, I built a 7-foot fence. What, I gotta have a machine gun nest too? That would've been good. We would've covered you shooting them. We don't cover the drowning. You gotta be careful with that kind of stuff. The big four. So these are the big four things that you can buy. And these are the ones that you're going to be faced with. Commercial general liability, which is your CGL policy. Workers' comp, or employer's liability, together. Property and business auto. Most people that come to me initially don't have property. Their property is their house. That's where they're working out of, or their garage. So we don't worry about the property. Business auto, it all depends. Are you going to have a fleet? Or maybe 1 or 2 trucks. Maybe you have a CDL. Okay, you look at business auto. Workers' comp, state of Texas, we're going to get into workers' comp because there's a lot of games to play with workers' comp. I want y'all to be aware of it because if you're not employers, you will be employees and you'll probably fall under workers' comp, and I want you to be aware of how the system works. But workers' comp is for employees to provide them with some sort of health benefit in the event that they were to get injured at work. You're saying, well, they should have insurance, right? A lot of people don't have insurance still, right? But even if they did, if the activity that caused them to do harm to themselves or hurt themselves was work-related, why should they have to come out of their own pocket? They were doing a job for you. You'd be surprised on that one. And again, commercial general liability, and we'll get more into the specifics on what each one encompasses. Oh, and there's also business owner policies, BOPs. BOPs, 90% of you guys are going to go into a BOP. That's just the way it is. It's cheap, it's minimal coverage, you need something to get it off the ground, so you do a business owner policy. This is where you mess up. You're 8 years into your game, you've netted $1 million, you broke $1 million, and you still have a BOP. I have a client right now that's running an $18 million construction company in LaPorte, Texas. When I pulled his files, he still had a lot. I'm like, you have no protection for 90% of the stuff that you are now doing. Where's your broker, and why haven't you communicated with him to let him know how your business is growing? He's like, well, he just comes out at renewal. Bad. So what is the commercial general liability coverage? It provides coverage for bodily injury or property damage caused by an accident. It also provides coverage for personal injury or advertising injury. Personal injury or advertising injury. Somebody lies about you, defames you. Your food is poison, right? And they put a billboard up and they have no truth to the matter. This will step up. Provides coverage for personal injury and advertising injury to protect you, okay? And the damages that happen because of that. Your homeowner's policy, side note, includes this. Why? Because insurance is funny like that, so they can throw it in there and not tell you about it. But if you have homeowner's insurance and somebody defames you or puts a billboard on and says something bad about you, and so your whole neighborhood wants you out, that's in there. That's in your homeowner's policy in the state of Texas. It doesn't cover contractual claims or disputes. There's no general liability hit. There's no way for it to activate if it's just a dispute, because you said, Pedro, that you were going to pay me for this catering $10,000 and you backed out. You didn't do harm to anybody. Remember, GL is third-party liability. You get nothing. You just paying off somebody else, okay? Except in this portion, which is the advertising. Property. There's real property, personal property, and business interruption. You may need a specialty policy for certain types of property. Business interruption was what we talked about, what happened in Boston with the bomber, okay? So with business interruption, that policy kicked in probably after a specified time, like it says, if you go 4 days interrupted business due to an act of whatever, a crime or something, it'll kick in. But read what the narrative says for your business interruption if you do get business interruption. Yes?
Does that include people that have businesses that also are part of huge construction?
Yes, yes. So let's say it's a big, I have a construction company where business interruption actually hurt them. They were interrupted because of Ike. So in the middle of doing their construction, all of a sudden, not only were the materials wiped out, but they couldn't do work for like a month while the cleanup around the area was done. So their business interruption insurance kicked in and paid for the losses. There was a lot that they had to show and prove, because as you can imagine, they're not going to give this money away just because one day you slept in, right? Oh, I was drunk, my business was interrupted. So let me call and file a claim. I should have been at work, but I have insurance, so I can stay in bed.
So the people that complain about how long the construction taking in their business, they should have this point.
Okay, so that's a great question. If you're going into construction, or you're going to have projects done.
Say you have a storefront, and you they come and redo your street, and it takes 2 years.
That's right. And you're going to file the claim.
Yeah.
So you're going to file the claim under your business interruption. What's going to happen is your insurance company will probably pay the claim, but they're going to subrogate against the city or the town to get that money back, because somebody is responsible. You're not responsible. You had damage done against you. If you didn't have insurance, then your only recourse would be to argue with the city, and you know how that is, right? So at least with insurance, the people with the big pockets, the insurance companies, they can come in and say, come on, you need to pay up. And the city usually figures out a way to pay up when big insurance lawyers step in.
So in terms of like a sole proprietor, business owner, business interruption, what would be the coverage for that?
So for let's talk about your restaurant, okay? Business interruption. Perfect example. If y'all been keeping up with the news, you have Chipotle had some major business interruption, right? Right? If they didn't have that, and not only Chipotle had business interruption, but they had to pay liability claims. They hurt somebody else. They did damage to somebody else. So they probably paid medical bills, they paid damages. Now, let's say it's Pedro that ate the bad burrito. I love that, the way that sounds. Pedro ate the bad burrito. So Pedro eats the bad burrito, and I'm out of work for a month. Who's paying that? Well, that GL policy is paying that. And that's where you see the commercials on the TV, and it says, have you been injured at work? Yeah. I'm at home right at the time when that guy's on TV. Imagine that. They do it on purpose, right? So he's gonna inform me about my rights. I'm gonna talk to that lawyer, and that lawyer's gonna basically sue or make a demand or an appeal to get that coverage to kick in, okay? But it's all, if you don't have, if you're not talking to your broker, it usually has to be done through a lawsuit.
So your broker should be on your side in that case, right? He should be the one.
If you're not communicating, I bet you he doesn't know. Okay? If you're not communicating, he won't know.
Yeah.
You gotta do your part, which is call him up and be like, hey, I'm sick because of this. Well, you wouldn't tell that to your broker. You tell that to an attorney. Okay? But where you're informed, where you have to inform your broker is, after 5 people call you saying that you made them sick, and all of a sudden you get a letter from an attorney saying that they're demanding something, you need to inform your broker so they can get the attorneys, your attorneys involved, to finish out that claim, to figure out what the damages are going to be.
So it's kind of more of a balance as to what you can actually communicate to your broker versus what you can communicate to say lawyer.
Well,
If you don't want to say everything, obviously, so what I'm getting is that you don't want to say everything to your broker.
you want to, if it's something against you, okay, and you're not the business owner, you're just the user, okay, then you lawyer up. If it's your business that's being attacked by a lawsuit, you have coverage, you need to inform your coverage, because that's what's usually going to pay for the legal fees. Okay? Baileys, this is very interesting, this applies to you. Baileys, in transit inland marine coverage on property entrusted or insured for the storage, repair, or servicing. All auto shops need Baileys. The reason why is because you're going to sometimes sit on an engine for a long period of time, and let's say your house or your shop catches fire. Or if you're traveling and you're taking something back to somebody that you fixed and you're in an accident. That Bailey's coverage is what's going to extend over the transportation shipment or the storage of other people's goods. Where I see Bailey's a lot in Houston is going to be your trucking and freight forwarding agencies. They have a lot of Bailey's coverage because they're taking lots of durable goods that are coming through their place. They let it sit there. Sometimes they have fires, like we just had like 4 fires in the last 6 months, which totally wiped out those places. All that equipment, everything that was in there is gone. So yes, that's going to be covered under different types of policy, but having a true Bailey's policy is no questions asked. Oh, you were holding something for Pedro and it burned? Here's your check. Whereas under a property loss, it might not be covered under property if you were transporting it. Because they'll say, well, that's covered under auto. And then the auto department says, hell no, that's not covered under us. And then they argue all the time. That happens every day, where parts of an insurance company will argue with each other to see who's going to take the loss. Or even worse is if you have several carriers working on your one claim, they'll argue with who's first, who's on first, who's on second, who's going to pay for this first. And that sometimes will take years in that argument. So make sure that you have the proper coverage. Business auto liability provides coverage for categories of vehicle and scheduled vehicles. It works in conjunction with your CGL. Okay? So it's important to have business auto coverage if you have business autos. And then there's all sorts of schedules. Work with your broker to go over the schedule list. Super important. Some other types of insurances that are out there for liability, there's going to be directors and officers. There's 3 types of potential coverages. Includes intentional acts. This is one of the few coverages that includes an intentional act. Intentionally going to defraud, right? So if a guy is going to steal from you, let's say that Enron, great example, right? At Enron, everything he knew he was embezzling. He knew he was doing that. Had they had, and they did have certain level of DNO, just not enough. Under DNO, the people that were defrauded, the liability, normally a GL policy doesn't pay for intentional acts. It has to be unintentional. But under DNO, they're basically rating a policy for you, and they will pay for the intentional act of your executive officer or one of your employees that's a director and officer of the company that did damage to somebody else or did harm to somebody else. It'll pay for it. It's available for the whole entity. There's data protection liability insurance, cyber, right? Are you going to take payments online? Yeah. You're going to hold on to customer information? Probably. You know, so there's customer sensitive information, and there's customer information that can't be shared. You have to be aware of which is what. And if you're going to be doing any sort of data collection, or even order taking, cyber liability insurance is super cheap right now, still super cheap. And if you think you don't need it, ask Target. When they got hit with their data breach, their CFO lost his job because their data breach cost them out of pocket because they didn't have enough cyber coverage. I think they were capped at, they had 5 million in cyber. It was just over 115 million in total damages to Target. They fired the CFO within 2 weeks of that notification, and they've had to pay all those damages. When it comes to damages, banks, oh man, if you're selling insurance, sell cyber to a bank, or you will make lots of money. Because banks live on that. Debit card transactions, ATM transactions, account statements, all that kind of stuff falls under cyber liability insurance.
So you said it's sort of early e-commerce stuff. Isn't the person that comes in paying the management?
Yes, but make sure that they have adequate coverage and that you're not excluded from their policy. That's a great question to ask, because if you're, let's say PayPal, if you're gonna use PayPal for payment processing, you need to understand the rules. If somebody were to come back and say, I had a transaction after I got my hair done with you, and all of a sudden I'm missing $500 from the bank. And you're like, oh shoot, I used to use PayPal, so let's call PayPal. And then you gotta know how to work it out with PayPal and understand what the coverage is, because they have a whole page on there. I know, because I run a little PayPal business for pets. So, anyway, they tell you if there's some sort of fraud, you have this much time to notify us. If you miss your 30-day window, you're eating the fraud claim. You know, all that kind of stuff. You need to be aware of that.
So, like, if you use like merchant services, like Square, or like do like Wells Fargo merchant services, are you protected from
You
it?
need to read it. You are protected.
Like, do you need to purchase like additional to protect yourself?
I can tell you for the direct purchases like Square, that information is delegated to you, so yes, you do need to protect it.
Yeah.
But if you're using, say, Wix, and Wix partners up with PayPal, and that way, the money goes into your website, and then that PayPal just goes to your account, you have a little protection, but you're never ever in touch with that personal information, then you don't need it as much. You still want it because you're at the end result, and they're still thinking they're doing business with you. But you just, so you want that extra little protection, so you don't need as much.
We're talking $1 million worth of coverage for a couple $100 tops. You know, it's, yeah, for the year premium. I mean, you pay that monthly too. So I mean, those type of coverages are really cheap. But again, remember that risk model I told you to start thinking about? Is it high chance, high probability? If you're gonna be taking a lot of online payments, then you have high probability. And what's the worst that can happen? Look at Target. So is it worth having that level of insurance? Absolutely. It's pennies on the dollar insurance. Fiduciary liability, again, people working with other people's money or making decisions, monetary decisions, should have that. Also, fiduciary liability comes into municipalities, people that are entrusted with the government's money or taxpayers' dollars, because we know they know how to spend our dollars, right? So they need that kind of coverage. And then you have E&O, which is like for me. If I just stand up here and I make up a whole bunch of stuff and then you guys go and get hurt, that's gonna pay for me, which I have lots of that, because I just make everything. So other types of liability insurance, you're gonna have internet liability insurance, which I'll be honest, I don't mess in this world too much. Employers' practices, I do mess in this world too much. I'll tell you a story so you can see how and then kind of the builder's risk that we have. That's coverage that protects a person's organizations and serve interest, materials, fixtures, and other equipment being used in construction of a building or structure should those items sustain physical loss or damage. In Houston, just recently, we had a, not a tow truck, it was a forklift operator clip the edge of a scaffold, knocking over a whole scaffold with 8 people on it. All of them survived, don't know how, because it was ugly, but he knocked over the whole scaffolding for the apartment complex that they were building downtown Houston across from the Astro Stadium, right? And the job went on stop for, I want to say it was like 5 months. No work was being done. Well, one of the companies was my client. They had steel pipes and rods out there that were going to be the plumbing that was going to go into these apartments. Well, in Houston, it's humid, and we're on the coast. What do you think happened to all that pipe? Destroyed. Over $10 million in pipe, just destroyed. We had to get rid of it. They had a limited builder's risk policy at the time. Luckily, we had updated it for this year, so they had full coverage, but that whole $10 million loss was paid for by the builder's risk policy. Now, pipe distributors, however, to tell you how the game works, right? Because I called in, I'm like, hey, our client had a claim, let me tell you the story, this is what happened, here's the pictures, get your adjuster on it. 2 weeks later, I get a call, they're like, we're denying the claim. I said, how? And they're like, there's an exclusion in your contract that says pipe distributors, pipes that are sitting in yards get rusty, and once rust is not covered. It's not a covered peril. So they were gonna say no because of the rust. But what was the key difference that I had to argue? I'm not a pipe distributor, we're a construction company. We bought it from a pipe distributor who was sitting on site, therefore it meets builder's risk. They came back the next afternoon, like, okay, you know? Because you have to understand how your policies work. Otherwise, nobody's gonna do that for you, okay? You have to understand. Environmental pollution, absolutely. You're gonna need the small pollution coverage because you're gonna deal with pollutants. You're gonna need it because, you know, food service industry, you have pollutants as well. Anybody that deals with anything that can be a possible pollutant. Water can be a pollutant. It can, in high quantities. It can kill stuff. Kill you if you drink too much waterboarding, or kind of. But we had a client that had a water spill. Just too much water was coming out of the drains. And it ruined the crops of a farmer next door. So I guess it was a pollutant. And they treated it as a pollutant. So then surety bonds. Surety bonds, they're not insurance for the purchaser, they're insurance for jobs. If you're doing work with the government or the city, you might be asked to produce a surety bond. Even though you get it from an insurance company, it's not insurance for you. Okay, it doesn't pay like insurance. You basically pay a premium and you pay a bond, and that bond pays out to somebody else that basically puts a claim against you saying they didn't finish the job. Or they went over budget on the job, so the bond kicks in protection. If you pop on a bond, good luck with your business for the rest of your business life. You're uninsurable if you pop a bond. Ask the construction companies here in San Antonio, I know 3 of them, I won't name them, that have all popped on bonds that are no longer in existence.
What do you mean by that?
For example, if I'm doing work, if I'm building this place, and I bid the project at $10 million, and because of my ineptness and the fact that I've never built a library before, I'm at $20 million, and I'm in the hole with what I bid, so then I'm gonna walk away from the job, that bond pays the city to find somebody to help finish the work. There might be completion bonds, there might be surety bonds that are based on performance bonds. There's all sorts of bonds. Bonds are financial instruments and they're based on your backing and your creditworthiness and your company's creditworthiness. So when I have a brand new construction company saying, Pedro, I need to bid this job, and it requires a $10 million bond, and I'm like, you've been in business 3 months, you're not gonna get a $10 million bond. Unless you have a lot of money in the bank that I don't know about. Because they're going to ask for your financials. It's going to be just like if you were going into a bank to get a business loan. They're going to ask for all that data. Transactional, life insurance policies is transaction. Excess and umbrella policies, you're going to hear a lot of excess and umbrella. Basically, it's shock loss, okay? And excess and umbrella policy goes above your GL policy. So if you have a $1 million GL policy and the demands against you at $4 million, you better have an umbrella. Because that's what's going to pay the reason that you went above and beyond. The other thing that's a good best practice is when you get your umbrella, you want it to match, to coincide with the underlying policy. Same language as the underlying policy, so they'll work together. Nothing worse than a broker that thought they were sophisticated, getting a policy from company A for GL, and then getting some super duper prime, crazy, fancy, cheap policy for an excess above it that doesn't even talk to each other. Because what's going to happen is once you blow through your minimums or your max on your GL policy, they're gonna go up and say, hey, excess, you got to kick in now. And excess is like, we exclude that. And so then you just bought a policy that doesn't cover anything. So you thought you were covered for $10 million, but the excess policy, since it didn't jive, it didn't talk with the underlying, it might exclude the damages altogether. It provides you with different limits of coverage, and here's where it came from. Now I'm breezing through this because we're down to 15 minutes, guys. I'll stick around if you want me. Excess umbrella policies are broader than the underlying policy and may provide coverage not present in the underlying policy. So there's some umbrella policies that are broader. I've seen umbrella policies that not only pay your GL, but the umbrella also goes over your auto and property. So if you blow through those, that umbrella kicks in. That's nice. Usually they're not that very expensive either. Although, I have a client right now that she wants to go from $1 million, she's a valve company. They do about 14, 15 million a year in valves. And she wants to work in the refinery, and the refinery said, in order for you to do business on our refinery and do business with us, you have to have a $10 million umbrella. Just to do business with us. So she's at 2 million. So she wanted to know how much it would take to bump her up to 10 million. It is substantial because the nature of her business. We're talking, to go from 2 million to 10, we're talking another $16,000 to $20,000 in premium a year. But she's making several million. She just needs to decide how she needs to price her goods to offset the levels of insurance that she has, right? Because if Exxon or Valvoline tells me, hey, we want to buy valves from you, and we'll agree to pay X over the next 10 years. Now you can create an RFP, right? You can create a proposal. You could create some sort of contract or some sort of agreement where you've priced that cost in. That's how insurance should work. It should never be like, Pedro, I can't do my job if you're asking me this insurance. No, the insurance comes first. That's part of the job, dude. You know, when you tell me that you want to hire, volunteer firefighters, and you haven't considered how much liability there is if they don't do a good job, and the building burns down, and you're like, well, the city's going to pay me, $10,000 a month. Yeah, but your insurance costs are going to be $20,000 a month. You think you're going to make any money? Oh, dang, I didn't even think about that. Happens all the time. Self-insured retention versus deductible. It's a dollar amount specified in the insurance policy that must be paid before the insurance policy will respond as a loss. Remember I told you the 80% rule? Okay, that you've covered a certain amount. Self-insured retention, like my elevator company that had a $5 million retention, they had to pay $5 million before the policy even wakes up. It's dormant until then. So you have to understand that's not a deductible, okay? Because you're not paying out of premiums. That's completely my pocket. It's usually employed by insurers who have frequent but small losses. TPA may be required.
So that's the self-insured retention, basically, if the damage was $500 million and $1, they'll pay the
$5 million. Let's say it's $5 million. $5 million and $1, they'll pay the $1.
Okay.
Thank you. But burn it all down so they pay for more. Really, $1 is what my insurance is paying?
And deductible, if you pay this amount, and then from there we'll take whatever is necessary.
That's right. So you're sharing in it with a deductible. In the self-insured retention, it's all you're born on. Here it is. The difference between a self-insured retention and a deductible is that a deductible is a portion of the covered loss for which the insured must reimburse the insurer. Whereas self-insured retention is a portion of the risk that insured retains itself. So one, the deductible, just like your health insurance deductible, you're paying Aetna back $250 because that was your deductible. That didn't make the loss cheaper, right? The loss is still $10,000 for that surgery. You're just paying $250 back to Aetna. In the self-insured retention versus deductible, you have your choice of defense counsel. Typically, an insured has an obligation to defend the suit with a self-insured retention. So even though there's self-insured retention and it's my money, in many cases, counsel, there's an obligation to defend by the insurance company. They're still going to get in there. Why do you think that is? It's not because you're a nice person. It's in their best interest to make sure it doesn't get above $5 million. So they're going to, oh, you need our lawyers? Hell yeah, we got you. You go, girl. Send our lawyers over there. We're going to keep that claim down to $2 million so we don't have to pay. Right? Because to them, that's what they use the lawyers for. Claims made versus occurrence-based. Real quick. You're going to see occurrence-based or claims made in a lot of your policy language, and they're going to ask you which one you want. Do you want your claims made? And in certain cases, if you become more sophisticated, you'll be able to go from one to the other. But look at occurrence versus claims made, okay? For insurance people that are learning insurance, to sell insurance, this is one of the hardest things for them to remember and how to learn how to do, okay? Insurance is active during this period of time, okay? The incident occurs here. You stop paying premiums in year 2. Insurance is still active because it's occurrence. The occurrence happened during the time I had insurance. So all this time, it'll pay. Claims made, my incident here, I stopped paying here, I'm not covered if the claim is made outside of the insurance period, right? So who's this important for? Definitely apartments, restaurants, things that there might be a lag in time before it comes back to bite you, okay? You might want to have an occurrence form that covers it. As long as I was covered during the time of it. Which one do you think is going to be more expensive? Because you have more coverage. Have more coverage. Now, what tentatively happens and what can get you guys in trouble is you have this, and you go to shop your insurance with a new broker, and the new broker comes back with this beautiful policy that's $300 less than what you were paying before. But it's not this, and you didn't realize it, because you've always done this, and he didn't tell you. There's a lot of ways that they can reduce price that'll hurt you if you don't know what they do. It looks good on paper. There's lots of ways that they can raise your prices that'll hurt you, and you won't know it. Especially with business auto is where I catch a lot of that. Like, you'll have workers' compensation, but then at the same time, with workers' comp, they'll have the same type of coverage that workers' comp already gives will be under the car and auto policy, and you're like, why am I paying twice for that? You gotta be careful. So why is there many issues with insurance companies? Because contracts aren't usually negotiated, form language doesn't match up. Specific notice provisions, you're responsible, this is what we were talking about earlier, it's your responsibility to immediately let somebody know that there's a claim pending, okay? If you wait too long, they can choose not to pay, especially if it's past 30 days. Okay. Obligation to defend versus indemnity, and I think I overkilled it on the indemnity clause, so I'm going to click through it. Basically, indemnification means make whole. Hold, you're going to get into, especially if you're doing contract work, you're going to do a lot of things called hold harmless agreements. Or somebody's going to present you with a hold harmless agreement, and it's going to read something crazy like this. Let me get to it. The duty to indemnify is not dependent on the duty to defend. There may be a duty to indemnify, even if the duty to defend never arises. And I'll get more into that. Look, right here. I want you to read this. So right now, today, broad and intermediate form indemnity agreements can be used only sparingly, especially in the state of Texas. Texas has one of the strongest anti-indemnification hold harmless statutes, especially for the oil industry, except for the oil industry, I'm sorry. But in construction, engineers, or contractors indemnifying engineers, there is language, okay? So what they'll try to say, and you might see one of these contracts come across, you're trying to do work for somebody, and they'll hand you this contract, this service agreement. And usually section 4 will be the indemnification clause. They'll say, you will hold me harmless and pay all my damages even if I'm negligent. Why would you ever do that? Because you have to if you want the job. And it sucks. Nothing you can do about it. There's some that you'll be able to fight in court, and there's some that, well, I wouldn't say court, with a good lawyer, a good internal counsel, might be able to reword it and strike it and say, too broad language, we're not going to do that. But when I was at Halliburton, do you think that if they turned down, if one of my subcontractors turned down my language, that I do business with them? There's a line out the block on people that want that contract, and they'll take it. So why is that bad? Because basically, it works like this. My employee is on your job site and decides to blow it up, right? And so the people that you were doing work for sue you, and you're like, it wasn't even me, it was them. I work for them. So you point at me, and then I go, I'm rubber, you're glue. Whatever you got shot back at me goes back to you, and you're paying for it, buddy. Because you signed my agreement that you were holding me harmless, even up to my own negligence.
Is there a counter-contracting?
Yes, and it all depends on what you are. The express negligence doctrine equals expressly stated parties' intent, no broad, all-sweeping language, and no inferences or implications can happen. And it has to be conspicuous language. So this is the way I usually read it. They forget to make it conspicuous language. What's conspicuous language in lawyer world? It has to stand out, right? Basically, it has to be like bold, different type font, blinky, something, right? If it's not conspicuous on section 4, and it just looks like everything else, you beat it right there. You don't even have to do anything about it. You can say it was inconspicuous. It wasn't written right. Now, if they're using some sort of online template, it'll be conspicuous, and then you can say, hey, can we make this so it's sole remedy for me, we'll pay, but we want to be covered under your policy. Because that way, their policy is going to outrubber your glue. I'm using your policy. You know, so it's going to come back to the company that hired you, which is why you hear things called OSIPs and CSIPs. Owner-controlled insurance programs or customer-controlled insurance programs, where they're basically the main, the GC, is using you as a sub, and you're using their insurance. That is a possibility to get around that, because now you're all on the same team. Okay? But here's another piece right here I'll show you. Oh, governments, by the way, that will be in all government contracts. Because local governments and codes will always have negligence, intention toward intellectual property, and failure to pay subcontractors, suppliers as part of the agreement. So if you're going to do contract work for the city or the government, be expecting the fact that that contract will say, even if my city employee damages and hurts or harms or does damage or whatever to property or to life, you're responsible for it, not my city. And look at how it reads. I'll give you all 5 seconds to look at that and go into a call. Because that's a real one. And she's used to that. She's like, oh yeah, I write these all the time. So look, this is one right out of one of my contracts. I was like, are you kidding me? But that's how they look. So you be aware, talk to your broker, usually your agency, your broker will have an attorney. You can send them your new contract clauses. You should send all your new contracts to be reviewed by your broker. All of them. Hey, I'm about to agree to this. Am I covered? I don't know why more people don't do that. Everybody should be doing that. Okay? So the insurance contains broad indemnity, prohibits any indemnitor from indemnifying, holding harmless, or defending any party, including a third party, against a claim caused by indemnities, negligence or fault, breach or violation of statute, or breach of contract. That is where contractors that are in construction get protected, is this statute. Okay? So they can, a contractor that's not in the oil industry, not dealing with energy, can use Texas broad anti-indemnity statute when facing one of those and say, you're going against the state statute. I'm not an energy contractor. I'm a construction contractor, or I'm a manufacturer, or I'm a service worker. I shouldn't have to agree to that, and they'll fix it. All right. So now you're like this, right? Super confused of everything I've talked about, right? This is the home stretch, and it's going to be in 3 minutes, all right? So it's going to be click, 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 and then I'll stand up here, and if y'all want to stick around afterwards, I'll answer all sorts of questions, right? I'm not going to do that. Basically, this is how some issues that come up with insurance. Insurer, and lawyer, they all fight. That takes time to pay off a claim. The whole time, you're depending on that money to pay the claim off, and you don't have the money, so then you go out of business. You have to be aware that things take time, especially when you're dealing with an insurance company and lawyers, because they're going to argue. They'll argue period marks on the policy language. Okay? The duty of the insurer, you need to work on behalf, your job as the insurer, okay, has to sacrifice. So if I'm travelers, I have to sacrifice my own good, my own money to make sure you're made whole because that was the contract we agreed with, okay? Must provide timely and complete response, which sometimes they don't. Duty of the insured, what your duties are. All policies contain a cooperation clause that requires the insured to assist in the defense of the case. If you choose not to help defend the case, insurance will cover you. Why would you not want to defend the case? Well, when you just want it to settle, or when you just want it to go away, or you get too busy to deal with it. I've had clients lose cases just because they were too busy. I'm like, we need you to go to court. They need you. You can't run from this deposition. They have to hear from you. And they choose not to, no coverage. CGL coverage, make sure you understand this, it does not apply to your work. That is one of the craziest issues, and you can read all sorts of fun stuff about GL policies not covering your work and the lawsuits between that. What that means to say is, I go into a construction, right? I'm a bricklayer, and while I'm laying bricks, this is a true story. Guy was laying bricks, and then they called up, and there was all this muck and dirt all over the brick facade of this new subdivision in Plano. So they called a brick sprayer to come out and just wash it down, power wash it. Well, he hadn't cleaned out the chemicals from the power wash, and the power wash chemicals, when they got on the brick, damaged the brick on about 17 houses, right? Well, this power wash company said, my GL coverage, I did damage to somebody else's property, my GL coverage would cover it. No, because that's your own work. It would have to be a third party's work for it to cover. Because your work is you're in the spray washing business and you did damage to the other house, property or physical damage to the houses, they're saying, under the way it's written on the GL coverage policy, there's no coverage for that. Because what's to stop you from going out and just spray painting houses with bad chemicals if you don't do a good job in your own job? And it's, you know, this is how they try to argue. They said, did he grab this is lawyers, did he spray on purpose? They said, yes, it's his job to spray. Well, because it was on purpose, there's no coverage. Well, when would he spray on accident? He would never. So you gotta be careful with the way these GL policies work and how they're worded. Okay? So more limitations, does not apply to employment claims. So you know on workers' comp or employees or people fired and stuff like that, the GL policy doesn't cover that. That's where your professional liability insurance will cover. This is important for you guys to know because I get more arguments from you guys than anything else on this. Payment. That guy was a liar. I shouldn't be responsible for that payment. There's no way. Why is my insurance company settling? Because when you sign a contract with the insurance company, one of the parts of the things that you're signing is that they reserve the rights to choose to fight, to settle, and to argue every matter on your behalf. So even though you think that is a lie, we shouldn't have to pay for that. That's a frivolous lawsuit. We should fight this. I have the evidence. I've had carriers come back and tell me it'll cost me $8,000 to settle. It'll cost me $30,000 to fight it in court. Let's just settle. But guess what happens to your premiums when they settle? That's what they get mad at. That's what people get mad at. But you don't have the right. It's their right. So the better you gain data to provide them to win the case, the more they're going to be willing to fight for you. All right. Look at that. I gave y'all. I will email this to you so y'all can watch it at home. And let me get to the last slide here since we're at the end. Look at that. I didn't even get into workers' comp. All right. So real quick, I'm just going to tell you about workers' comp. Workers' comp, if you have more than one employee, I would recommend you figure out a way to get workers' comp because workers' comp is sole remediation. Sole remediation in the world of law means you can't sue. It's already been worked out between two parties. That means if I'm an employee for you, okay, and I burn my hands with some chemicals that I'm learning how to use to do somebody's hair. Well, if you don't have workers' comp, and I go to the hospital, I can present you with that bill. And you're like, I don't know why you presented me that bill. You should have had health insurance. So then I present you with a lawyer's letter saying, pay my bills. You told me to mix those chemicals and burn my hand. And so now, yeah, even if I had health insurance, even if I had, it didn't even matter. Now the lawyer is demanding that you pay for my damages and my suffering and everything, right? So what would have been a simple payment now has become a lawsuit against you, right? Under workers' comp, oh, you're hurt. Go to the clinic real quick. They'll take care of you. Your premium's already paid for that. I can't come back and say, you're a horrible boss that made me mix these chemicals, I'm suing you. No, they can't. I have a case right now that I was being deposed for that was a death. A guy died, okay? And in the deposition, what came up was, it was workplace violence. Guy came in with a gun and shot the boss, right? Does insurance cover that? Does workers' comp cover that? We argued that workers' comp should cover it, and he did win the argument because it was in the due course of him doing work at work. He didn't know the person, he hadn't had an interaction. This was a disgruntled employee that came in with a gun and shot the guy, right? Problem was, if there wasn't workers' comp, well, because there was workers' comp in this case, his family tried to sue for above and beyond what the settlement amount through workers' comp was. The court said, is there workers' comp? Yes, sir. Was there negligence? Yes, sir, there was a little bit of negligence. Was it gross negligence, which is a higher standard, a much higher, tougher standard to prove? And they're like, we couldn't prove gross negligence. The judge said, no settlement, no award, I'm not even hearing the case. Because it's sole remediation, so it protected the company. Had they not had that, they were going to get sued for like $20 million for a wrongful death. Okay? So those type of things are important. If you want to protect yourself, and you're in an industry that can cause people to get hurt, get workers' comp. For pennies on the dollar, you can't beat it. In the state of Texas, it is sole remediation, and it's a state-managed program, so it's usually a little bit cheaper. You can find people to be competitive with that. And last slide, I tell you how to not get claims on workers' comp, so if you're going to have employees, you can stick around and ask me about that, because there's some fun ways that you can make sure. But under workers' comp system, guys, because you guys probably will be under workers' comp too, all of you guys have the right to be treated at a hospital or clinic if you're working for somebody that offers workers' comp. It's a lifelong treatment. I fell last year and hurt my shoulder. This year, workers' comp called me back. My shoulder hasn't hurt in forever. They called me back and like, can you come in and let us check your shoulder again? I'm like, it's fine. They're like, doesn't matter, for the rest of your life, we're responsible for that shoulder. It's like, really? So I was like, oh. I was like, it won't go up, I need more medicine. No, I didn't do it. But the doctor raises your arm and the whole thing, but you know what? I got a check for $10,000. Because they said that for the rest of my life, my shoulder would not be able to raise above my head. I can't, and a part of my job was climbing. I did audits and inspections on towers. So I can't do that I can do that. I told them, I was like, I can do this job. I'm like, not as good as you could have. And here's another thing, we're all young. When you get older, that shoulder, you're gonna feel it. And they tell me that in the clinic all the time. They're like, I know you don't want our money. I know you're acting like a big, tough Marine, but the truth is, once you turn 65, if you make it that far, your shoulder is gonna be the thing that's gonna be like, oh, I can't get out of bed, I should have got more money for my shoulder. So I said, just be happy that the state's giving you this. But that's all employers, okay? You hurt your back at a company, and you get workers' comp, your back is paid for the rest of your life. They will always fix your back. Unless, and let me leave this, and this will be my parting gift to you, if they catch you on camera doing something that shows that your back is not hurt, and you're playing with your kids, they're gonna stop payments that second and say, oh, you're healed, or you're healed beyond what we thought. Because obviously there's been maximum medical improvement, and you can move around just fine, so we're not paying for it. Or if you take a job that requires you to use that appendage in a certain way and you prove that you can, they'll start paying it too. Now, if you have a husband that dies at a job and workers' comp pays the death benefit, which will be 70% of their income annualized, basically they take it over the last 2 years snapshot, and they'll pay that for the rest of your life as a spouse, unless you remarry. So keep the Sancho, and be like, hey, I love you, but we ain't getting married because I got money coming in, and you ain't making that much. You know, so remember that. That's true, that's out there. As soon as a spouse remarries, the money's gone. For kids, the kids get a portion that's cut off to them, and they get it till 18, unless they go to college, and they get it to 24. Okay? So there is remediation and benefit out there. Can you sue a company if they injured you on the job? Well, we said no, right? You can sue anybody for anything in America. So just because the law says that a judge isn't supposed to listen to the case, doesn't mean that somebody might get lucky and say, I think there is some criminal negligence there. I'll give you a fake example of a case just like that. So no criminal negligence, right? There was negligence involved because the background check did not show that this person was an offender, right? They didn't go that far. Had they gone a little bit further, the case would have proven that, in fact, this individual had a background, a record. Now, this is all hypothetical. I'm trying to come up with a scenario where it would fail, okay? So you have an individual that had a hidden criminal record, had somebody done a little bit deeper search. All of a sudden, the judge that's lenient says, y'all should have searched more. I think it's criminal negligence, family, sue away. And they'll listen to the case. But in most cases that I have seen in Texas where somebody gets hurt on the job, it stops right there if there's sole remediation and it pays down. Yes, your question?
This may be a silly question.
There's no silly questions.
As far as, you probably said this earlier, if you didn't, sorry, I had the gas out. But as far as interns and volunteers.
Interns and volunteers. You want to make sure that you get a special policy for interns and volunteers because they would not be covered under your traditional general liability policy. Okay? There's been one in just exactly what you speak of. There's a case recently that's open right now where an intern at some big company, she was sexually harassed, and insurance didn't pay because they're like, she's an intern, she's not covered under the policy. So those type of things do happen.
Even if it's a paid internship?
That changes things. Paid internship changes things, all right? Because now we're seen in certain states as employees, okay? That's a paid intern. That's what I have, guys. I have a lot more. If you leave your email address and leave information behind, I would love to send this out to you. You can't download this online because I just created it last night, okay? And I haven't uploaded it anywhere. If you have questions, I'll stick around for a while. I'll be happy to visit with you and give you anything and give you cards. I'm here for you guys, okay? I'm not here to sell anything. I don't make any money selling anything today or anything like that. I'm not pushing anything, just knowledge, okay? Thank you, guys.
Excuse me, do you have, you're a lawyer, but do you have a card?
If
down on the
What's
desk,
your-
and we'll pick those up. And also
Can you
share
tell
with
me?
us other topics that you're interested in hearing more about. I also passed around our upcoming quarterly workshops, so we encourage you to come out to some of the classes that we have
Just
coming up in the next 3
generally
months.
to have you on
Including
file.
tomorrow evening, we're doing our
Yeah.
entrepreneurship legal clinic. So that is an opportunity to get a free 30-minute consultation from an attorney on any business-related topic. We highly encourage you to register in advance through Eventbrite, so you can go through either eventbrite.com or go to the Lyft Fund website /events to register in advance. For those of you interested in transitioning from sole proprietorship to an LLC, you can also get assistance from the attorney